While everyone's buying at the top, one guy's made billions doing the exact opposite. Here's how Sam Zell became the richest grave dancer in history. March 2007, Chicago. Sam Zell is sitting in his office, smoking a cigar, looking at a term sheet for $8.2 billion. It's an offer to buy his company, Equity Office Properties, the largest office building owner in America. He built this thing over 30 years, owns 580 office buildings across the country, and Blackstone just offered him $8.2 billion in cash. His team is celebrating. This is the biggest real estate deal in history. They're about to get rich, really rich, but Sam's not celebrating. He's got this look on his face. His CFO knows that look. What's wrong? Sam takes a drag from his cigar, blows out smoke. Nothing's wrong. This is exactly right. His CFO's confused. Then why aren't you happy? Sam leans back. Because I know what comes next. They're buying at the absolute peak, the top. I've seen this movie before, and I know how it ends. 18 months later, Lehman Brothers collapses. The financial crisis hits. Commercial real estate crashes. Blackstone's investment loses billions. But Sam's sitting on $8.2 billion in cash, and he's about to do what he's done his entire career: buy everything everyone else is desperate to sell. They call him the grave dancer because he makes his money in other people's disasters. When everyone's panicking, when everyone's selling, when everyone thinks the world's ending, that's when Sam Zell gets rich. He's been doing this for 50 years, built a $5 billion fortune doing it. And the playbook, it's completely repeatable. That's what we're breaking down today. I'm Alex Morgan. This is Behind the Billion. And today we're diving deep into Sam Zell, the grave dancer, the guy who built a $5 billion fortune by buying when everyone else was selling. And look, I spent the last week and a half reading everything I could find about Sam Zell. His autobiography, Am I Being Too Subtle?, which is honestly one of the most entertaining business books I've ever read. Old interviews from the 70s and 80s. SEC filings on every major deal he's done, talked to some people who worked with him, and here's what I found. Sam Zell might have the most repeatable wealth creation framework I've ever studied. Everyone talks about Warren Buffett's be fearful when others are greedy thing. Sam Zell actually does it, actually executes. He's made his fortune not by being the smartest guy in the room, but by having the guts to buy when everyone else is terrified, and the discipline to sell when everyone else is euphoric. That's it. That's the entire playbook. But executing it, that takes balls of steel. And Sam's got them. The guy rides a motorcycle, wears leather jackets to board meetings, smokes cigars in his office, tells people exactly what he thinks even when it pisses them off. He's worth $5 billion and he still doesn't care what anyone thinks of him. Never has. That's part of why he's been so successful. All right, let me take you back to the beginning. Sam Zell is born September 28, 1941 in Chicago, but his story actually starts in Poland. His parents are Polish Jews. His dad's a grain trader, successful, doing well, but it's the 1930s. Things are getting bad, Hitler's rising, anti-Semitism is spreading. Sam's parents see it coming. They're not naive, they're not hopeful, they're realistic. And in 1939, right before the war starts, they get out. They literally escape. Make it to America with almost nothing. Sam grows up hearing these stories. His parents left everything behind, their business, their money, their friends, everything, because they understood risk. They understood that when things look bad, they're probably worse than you think, and the people who survive are the ones who act early, who don't wait, who make the hard decisions when everyone else is in denial. This shapes Sam fundamentally. He grows up with this mentality: trust your instincts, act decisively, don't follow the crowd gets killed. His dad rebuilds in Chicago, starts trading grain again, does okay. The family's comfortable, not rich but comfortable, and Sam's watching how his dad operates. His dad's a trader. He's buying when prices are low, selling when they're high, not getting emotional, just reading the market, finding opportunities. Sam's a smart kid, really smart, but not studious, not a teacher's pet. He's entrepreneurial, he's looking for angles, he's thinking about money constantly, how to make it, how to multiply it, how to not work for someone else. He's 13 years old, he's reading the classified ads in the Chicago Tribune, and he notices something. Playboy magazine just launched, Hugh Hefner's in Chicago, and Playboy's selling like crazy. Every newsstand's sold out. There's huge demand, but supply's limited. Sam has an idea. What if he bought Playboy magazines in Chicago, where they're printed, where supply is better, and sold them at his summer camp in Wisconsin, where there's no supply? Arbitrage. He's 13 years old and he's thinking about arbitrage. So he does it, buys Playboys for 50 cents in Chicago, brings them to camp, sells them for $3, makes a killing, 6 times markup. His counselors are pissed. The camp administrators shut him down, but Sam doesn't care. He proved the concept, find inefficiency, exploit it, make money. This is the seed, this is where it starts. Fast forward, Sam goes to University of Michigan for undergrad, studies business, but honestly he's bored with classes, he's more interested in real opportunities. And in college he starts noticing the student housing situation. There's not enough off-campus housing, students want apartments, landlords want tenants, but the market's inefficient, no good way to match them. Sam starts a tenant referral service, connects students with landlords, takes a fee from both sides. It's a simple idea, but it works. He's making money, good money, while he's in college. But more importantly, he's learning the real estate business. He's talking to landlords, learning about occupancy rates, learning about cash flow, learning about leverage, and he starts thinking, why am I just connecting people? Why aren't I the landlord? So Sam does something crazy. He's still in college. 1962, he's 21 years old, and he buys his first apartment building, borrows the down payment, 15 units, in Ann Arbor near campus. Now think about this, he's 21, he's a student, he has no money, and he's buying an apartment building. Most people at 21 are trying to figure out what major to pick. Sam's building a real estate empire. And it works. The building cash flows, he's collecting rent, paying the mortgage, making money, and he realizes something fundamental, something that becomes his entire philosophy. Real estate is the best business in the world if you buy it right. Here's why. Real estate throws off cash. Every month, predictable, tenants pay rent, you pay expenses, what's left is yours. And if you use leverage, if you borrow money to buy it, you can amplify your returns. Plus, real estate appreciates over time, and you get tax benefits, depreciation, deductions. It's the perfect asset class. But, and this is the key, you have to buy it right. You can't overpay. You can't buy at the peak. You have to buy when there's distress, when sellers are motivated, when you can get a discount to intrinsic value. Sam figures this out at 21 years old, and he never forgets it. He graduates from Michigan, goes to law school, gets a law degree, but he never practices law, never intended to. He just wanted to understand contracts, understand legal structures, understand how deals work. The degree's a tool, not a career. By the mid-1960s, Sam's in his mid-20s, and he's buying more properties, small apartment buildings around college campuses. He's got a simple strategy: buy near universities. Students need housing, demand is stable. If you buy the right properties at the right price, you print money. But Sam's thinking bigger. He doesn't want to just own a few buildings, he wants scale, he wants to be a real operator. So he starts raising money, finds investors, promises them good returns, uses their capital to buy more buildings. And this is where Sam develops his reputation. He delivers. His buildings perform, his investors make money, he's honest, transparent, doesn't bullshit people. If a deal's not going well, he tells you. If he makes a mistake, he admits it. This builds trust, and trust is everything in the capital-raising business. By the early 1970s, Sam's got a real business. He's managing hundreds of units. He's got a team. He's got investors lined up. He's making good money, but then something happens that changes everything. The 1970-3197 for recession hits. Now most people see a recession and panic. Real estate crashes, values drop, people can't pay their mortgages, banks are foreclosing left and right, developers are going bankrupt. It's a bloodbath. Sam sees opportunity. See, here's what Sam understands that most people don't. When there's distress in the market, when everyone's desperate to sell, prices drop below intrinsic value. Buildings that are worth $10 million are selling for $5 million, $6 million, because nobody has capital, nobody wants to buy, everyone's scared. But if you have capital, if you kept dry powder, if you didn't over-leverage yourself, you can buy incredible assets at incredible prices. And when the market recovers, and it always recovers, you make a fortune. So Sam starts buying aggressively. He's buying apartment buildings from developers who are bankrupt, from banks that foreclosed, from sellers who are desperate, and he's paying 50 cents on the dollar, 40 cents, sometimes less. His investors are nervous. Sam, the market's crashing. Why are we buying? Sam tells them, because nobody else is. That's exactly when you should buy. This is contrarian investing at its purest, and it works. Over the next few years, as the economy recovers, Sam's properties double in value, triple. His investors make huge returns, and Sam's reputation as a distressed buyer spreads. People start calling him the grave dancer because he's making money off other people's failures, dancing on graves. Sam loves it, leans into it. He'll later say, "The grave dancer title is one of my favorites. It's accurate. That's what I do." But here's the thing, Sam's not vulturing, he's not screwing people, he's providing liquidity when nobody else will. He's buying from people who need to sell, who have no other options. He's actually helping them, but he's doing it at a price that makes sense for him. That's business, that's capitalism. And Sam's not apologetic about it. He'll tell you straight, "I'm in business to make money. If you're in distress, I'll buy your asset, but I'm buying it cheap because that's the risk I'm taking." This honesty is refreshing. Most people in business try to pretend they're doing you a favor. Sam just tells you the truth, take it or leave it. By the late 1970s, Sam's got a serious operation. He's one of the biggest apartment building owners in the Midwest. He's got thousands of units. He's managing them well. Cash flows strong, but Sam's getting bored with just apartments. He wants to diversify. He wants bigger deals. So he starts looking at other real estate sectors. Office buildings, retail, industrial, and he starts noticing inefficiencies everywhere. The commercial real estate market is fragmented, unsophisticated. Most owners are small-time. They don't have professional management, don't have scale, don't have access to cheap capital. Sam sees an opportunity to consolidate, to buy up properties, to professionalize the management, to leverage scale, basically to do what Walmart did in retail but in real estate. He starts buying office buildings, small ones at first, then bigger ones, and he's applying the same principles: buy below replacement cost, buy when there's distress, fix operations, increase cash flow, refinance or sell at a profit. It's working. Sam's making money, building wealth, but he's still relatively unknown outside of Chicago real estate circles. That's about to change. 1980s, the savings and loan crisis hits. Now let me give you context on what happened. Throughout the 1980s, savings and loan banks, S&Ls, were lending money like crazy to real estate developers. Lending on spec projects, over-leveraged deals, stupid stuff, and when the economy slowed down in the late 80s, these loans went bad, buildings didn't lease up, developers couldn't pay their mortgages, and the S&Ls started collapsing. The government had to step in. The FDIC took over hundreds of failed S&Ls, and they were sitting on billions of dollars worth of foreclosed real estate. Office buildings, shopping centers, hotels, everything, and they needed to sell it fast because taxpayers were on the hook. This is Sam Zell's Super Bowl. He's got capital, he's got experience buying distressed assets, and he's got the balls to act while everyone else is paralyzed. So Sam starts buying. He's buying entire portfolios from the FDIC. He's buying at 30, 40, 50 cents on the dollar, and he's buying big. One of his most famous deals, he buys a portfolio of office buildings from a failed S&L for $400 million. These buildings are worth probably $800 million, maybe more, but nobody wants them. Market's scared, credit's tight. Sam steps in, buys the whole portfolio, and within a few years, as the market recovers, they're worth over $1 billion. This is where Sam makes his first serious fortune. We're talking hundreds of millions of dollars in profit, and his reputation explodes. Everyone in real estate now knows who Sam Zell is. He's the guy who cleans up after disasters, the grave dancer. But Sam's not done. He's thinking bigger. He wants to take his operation public, create a permanent capital vehicle, a way to raise billions and buy assets forever. So in 1993, Sam does something revolutionary. He creates Equity Office Properties Trust. It's a REIT, Real Estate Investment Trust, publicly traded. And the strategy is simple: buy office buildings across America, professionalize management, generate stable cash flow, pay dividends to shareholders. This is genius. See, most real estate investors are stuck in the private market. They have to constantly raise money, deal with individual investors, limited partners who get nervous. But a public REIT, you raise money once in the IPO, then you've got permanent capital. You can buy aggressively, scale quickly. And if you do it right, your stock goes up, you issue more shares, you buy more buildings. It's a compounding machine. Sam takes Equity Office public, and it works. The stock performs well, investors love the cash flow, the dividends, the stability, and Sam uses the platform to buy more and more office buildings. By the early 2000s, Equity Office is the largest office building owner in America, over 580 properties, $20+ billion in assets. Sam's now a billionaire, but he's still the same guy, still smokes cigars, still rides his motorcycle to work, still tells people exactly what he thinks, still doesn't care about conventional wisdom. And in the mid-2000s, Sam's noticing something. The commercial real estate market is getting frothy. Prices are going up. Cap rates are compressing. Buyers are paying stupid prices. Leverage is everywhere. It's starting to feel like 1989 all over again, like the S&L Crisis. Sam's colleagues are excited. Their properties are worth more than ever, but Sam's not excited. He's worried. He's seen this before. He knows how it ends. So Sam makes a decision. He's going to sell all of it. It's 2006. Sam quietly puts equity office on the market, not publicly. He's shopping it to private equity firms, to sovereign wealth funds, to anyone with billions to spend. And he's telling them, I'll sell you the best office portfolio in America, but you're paying top dollar. Blackstone bites. They offer $36 billion, later revised to $39 billion, including debt, the largest real estate deal in history. Sam will personally make over $1 billion from the sale. His board is thrilled, his shareholders are thrilled, everyone's making money, but some people think Sam's crazy. It's 2006, the economy's strong, real estate's booming, why sell now? Sam's answer is pure Sam, because I can, because someone's willing to pay top dollar, because I've been through enough cycles to know that this doesn't last forever, and because I'd rather sell a year too early than a day too late. The deal closes in February 2007. Sam walks away with over $8 billion in cash for equity office. Blackstone owns the buildings now. 18 months later, Lehman collapses, the financial crisis hits, commercial real estate crashes, office buildings lose 30, 40, 50% of their value, credit freezes, the market's in free fall. Blackstone's investment in equity office, underwater, they overpaid at the peak, they're losing billions. But Sam's sitting on cash and he's doing what he always does. He's looking for distressed assets. He's looking for motivated sellers. He's looking to buy cheap. This is the grave dance in action. Sell at the top, buy at the bottom. It's simple, but almost nobody does it because it requires you to be contrarian, to sell when everyone wants to buy when everyone wants to sell. Sam's been doing this his entire career. That's why he's worth $5 billion. Now let me talk about Sam's philosophy on risk, because this is critical to understanding how he thinks. Most people think about risk wrong. They think risk is volatility, price movements, stocks going up and down, real estate values fluctuating. That's not risk to Sam. Risk to Sam is permanent loss of capital. It's buying something for $100 and it's actually worth $50. It's not being able to sell when you need to. It's being forced to sell at the worst time because you're over-leveraged. Sam structures everything to avoid that. He never over-leverage. He always keeps liquidity. He always has access to capital, because when everyone else is forced to sell, when they're over-leveraged, when their lenders are calling loans, that's when Sam's buying. Let me give you a concrete example. Financial crisis, everyone's panicking. REITs are crashing. Real estate's crashing. Sam's sitting on that cash from selling equity office, and he starts looking at opportunities. One sector he's looking at, distressed debt, mortgages on commercial properties. These mortgages are trading at 30, 40 cents on the dollar because people think the borrowers are going to default, think the properties are worth less than the loan amounts. But Sam's doing the math. He's looking at specific properties. He's analyzing the cash flows. And he realizes some of these properties are fine, they're cash flowing, they're going to survive, but the debt's trading cheap because of panic. So Sam starts buying the debt. He's buying mortgages at huge discounts. And his thinking is simple. Either the borrower pays me back, in which case I make a huge return because I bought the debt cheap, or the borrower defaults, in which case I own the property and I bought it at an effective price of 40 cents on the dollar. Either way, Sam wins. This is asymmetric risk. Heads I win, tails I don't lose much. Sam structures every deal this way. He's always looking for situations where his downside is protected but his upside is huge. And this comes from his childhood, from his parents fleeing Poland, from understanding that the worst-case scenario is often worse than you think, so you always protect your downside, always keep optionality, always have a way out. This is why Sam never goes bankrupt, never gets wiped out. Even in the worst markets, he survives because he's paranoid about risk. Let me talk about Sam's operating philosophy, because it's different from most real estate guys. Most real estate investors are passive. They buy a building, hire a property manager, sit back and collect rent. They're not really running a business, they're just owning an asset. Sam's different. Sam's an operator. He's actively managing his properties. He's looking at occupancy rates, lease rates, tenant mix, expenses, capital improvements. He's optimizing everything. And he's built systems, professional management teams, standardized processes, technology. He treats real estate like an operating business, not just a passive investment. This is one of his competitive advantages. When Sam buys a distressed property, he doesn't just hold it. He improves it, increases occupancy, raises rents, cuts costs, increases cash flow, then he refinances or sells at a much higher value. He's creating value, not just betting on appreciation. And this is why his returns are so high. He's not just buying assets, he's running businesses. Let me tell you about another major Sam Zell deal, because it shows how he thinks about different sectors. In the 1990s, Sam starts looking at manufactured housing, mobile home parks, and everyone thinks this is a terrible business. Mobile homes are seen as low-class, trailer parks, nobody wants to own them. But Sam sees something different. He sees that manufactured housing has incredible unit economics. Here's why. The residents own their homes, their trailers, but they rent the land from the park owner. So the park owner has almost no maintenance, no appliances breaking, no interior repairs, just maintain the land, the infrastructure. And the residents can't easily move. Moving a mobile home costs $5,000, It's expensive. So once someone's in your park, they stay, low turnover, stable cash flow. Plus, there's very little new supply. Nobody's building new mobile home parks. Zoning won't allow it. So existing parks have a monopoly in their area. Sam sees all this and he starts buying mobile home parks aggressively. He creates a company called Manufactured Home Communities and he rolls up hundreds of parks. People think he's crazy. Sam, this is trailer parks, this is low rent, where's the upside? Sam doesn't care, he knows the numbers work and he's right. The cash flow's incredible, the returns are amazing, and eventually he takes the company public, and it performs really well. This is classic Sam Zell. Find an unsexy sector that everyone's avoiding. Identify the fundamental economics. If the numbers work, buy aggressively. Let the cash flow prove you right. He does the same thing with self-storage, with parking garages, with radio stations. He's always looking for sectors where the fundamentals are good, but everyone else is ignoring them because they're not glamorous. Now let me talk about Sam's biggest failure, because it's important, and it's a lesson. Right after Sam sells Equity Office, he's got all this cash, he's looking for his next big move, and he decides to buy a newspaper company. Tribune Company owns the Chicago Tribune, LA Times, a bunch of other newspapers and TV stations. Sam thinks he sees an opportunity. The newspaper industry's in decline, everyone knows it. Print advertising is dying, internet's taking over, but Sam thinks the assets are undervalued. The real estate alone, the printing plants, the office buildings, is worth more than the company's trading for, and the TV stations are valuable. He can sell off pieces, unlock value. So Sam buys Tribune Company, $8.2 billion deal, mostly debt financed. He's using leverage, which is unusual for Sam, but he thinks he can turn it around quickly. It's a disaster. The financial crisis hits, advertising collapses, revenues fall off a cliff, and Sam's got all this debt, he can't service it. The company files for bankruptcy in 2008. Sam loses over $300 million personally. Creditors lose billions, employees lose jobs. It's Sam's worst deal ever, and he admits it openly. He'll tell you, I fucked up, I misread the industry, I overestimated the value of the real estate, I underestimated how fast print would die, and I used too much leverage. This is classic Sam. He doesn't make excuses, doesn't blame others, just admits the mistake and moves on. But here's what's interesting. Even with this massive failure, Sam's still worth billions. Why? Because he didn't bet everything on one deal. He had diversification. He had other investments. He protected his downside even when he made a bad bet. This is risk management. Even the best investors make mistakes. The key is making sure no single mistake wipes you out. Sam walks away from Tribune humbled but not destroyed, and he goes back to what he knows: real estate, distressed assets, contrarian plays. Let me talk about Sam's investment in equity residential, because this shows his full-cycle thinking. In the 1990s, while Sam's building equity office for commercial, he's also building equity residential for apartments. Same model, roll-up apartment buildings across America, professional management, public REIT, scale. Equity residential goes public, performs well, becomes one of the largest apartment owners in America, but Sam's always watching the cycle, and by the mid-2000s he's noticing apartment prices are getting high, cap rates are tight, it's getting hard to find good deals. So Sam starts selling, not the whole company, he's still chairman, but he's selling properties, taking profits, building cash. Then 2008 hits, apartment values crash, and Sam's got cash ready. Equity residential starts buying again, aggressively, buying apartments at 20–30% discounts. And as the market recovers over the next decade, those properties double in value, triple. Equity residential stock goes from $20 in 2009 to over $80 by 2020. This is full-cycle thinking: sell when prices are high, build cash, buy when prices are low, ride the recovery, repeat. Sam's been doing this for 50 years, that's how you compound wealth. Now let me talk about Sam's personality, because it matters. Sam's not your typical billionaire. He's not polished, not diplomatic, not politically correct. He says what he thinks, and he doesn't care if it offends you. There's a famous story from the early 2000s. Sam's at a real estate conference. He's on a panel. Someone asks him about diversity in real estate, about hearing more women and minorities. And Sam says, "I hire based on competence. I don't care what color you are or what gender you are. If you're good, you're hired. If you're not, you're not." The room's uncomfortable. People think he's being insensitive, but Sam doesn't care. He's telling you what he actually believes, not what he's supposed to say. And here's the thing, Sam's firm actually has a lot of women in senior positions, more than most real estate firms, because he really does hire based on competence. He's not virtue signaling, he's not pretending, he's just running a business. This authenticity is part of Sam's brand. You always know where you stand with him. He's not going to tell you what you want to hear. He's going to tell you the truth, even if it's harsh. And in business, that's valuable. You want partners who tell you the truth, who don't sugarcoat, who give you honest feedback. Sam's built his reputation on that, and it's helped him attract the best people, because high performers don't want BS, they want honesty, they want someone who's going to challenge them. Let me talk about Sam's approach to leverage, because it's nuanced. Sam uses debt, of course he does. Real estate's a leverage game. If you don't use debt, your returns are too low, but Sam's very careful about how he uses debt. First rule, never be in a position where you're forced to sell. This means keeping leverage low enough that even in a downturn, you can cover your debt service. You're not getting margin calls. Banks aren't forcing you to liquidate. Second rule, match your debt duration to your hold period. If you're planning to hold a property for 10 years, get a 10-year loan. Don't get a 3-year loan with a refinancing risk, because if the market's bad in year 3, you're screwed. Third rule, keep liquidity. Always have cash or credit lines available, because the best opportunities come when nobody else has liquidity. If you're fully invested, fully leveraged, you can't take advantage. These rules sound simple, but most real estate investors violate them. They over-leverage, they use short-term debt, they keep no reserves, and when the cycle turns, they get wiped out. Sam never gets wiped out because he follows his rules religiously. Let me tell you about Sam's relationship with his investors, because this is important. Sam's raised billions from investors over his career, and his track record is incredible. His funds have consistently outperformed, delivered double-digit returns, made people wealthy. But Sam's not a salesman. He doesn't pitch, he doesn't wine and dine, he doesn't promise anything. He just shows you his track record and says, "This is what we do. If you like it, invest. If you don't, don't." And once you're in, Sam's brutally honest. If a deal's not going well, he tells you immediately. He doesn't hide problems, doesn't spin, just lays out the facts. This builds trust. Investors know that Sam's not going to bullshit them. He's not going to surprise them with bad news. He's going to tell them the truth, even when it's uncomfortable. And because of this trust, Sam's investors stick with him through multiple cycles, through downturns, through mistakes. They know he's aligned with them. He's got his own money in the deals. He's not just collecting fees. This is the right way to run an investment firm, but it's rare. Most managers are focused on raising assets, growing fees. Sam's focused on returns, on making his investors money. The assets and fees follow naturally. Now let me talk about one of Sam's core mental models, replacement cost. Sam's obsessed with replacement cost. What would it cost to build this building today? If you're buying an office building for $50 million and it would cost $100 million to build from scratch, you're getting a deal, even if the market's soft, even if occupancy's low, because at some point supply and demand will balance, and when they do, your building's worth replacement cost. This framework kept Sam out of a lot of bad deals. When everyone was overpaying in 2006-2007, Sam was calculating replacement costs. And he realized buildings are trading at 120%, 130% of replacement cost. That's unsustainable. New supply will come in, prices will fall. That's why he sold, not because he predicted the financial crisis. He didn't, but because the math didn't work. Buildings were overvalued relative to replacement cost. This is a simple but powerful framework, and it applies beyond real estate. In any business, ask, what's the replacement cost? What would it cost a competitor to replicate this? If the price you're paying is way above replacement cost, you're probably overpaying. Let me talk about Sam's views on management, because he's got strong opinions. Sam believes in decentralization. He doesn't micromanage. He hires good people, gives them authority, holds them accountable for results, but he doesn't tell them how to do their job. He says, I hire smart people and let them do their thing. If they need help, I'm here. If they screw up, they're gone, but I'm not going to babysit them. This is efficient, it scales. Sam's been able to run massive organizations, thousands of employees, billions in assets, because he's not trying to control everything. He's built systems, hired good people, and let them execute. But he's also ruthless about performance. If someone's not delivering, Sam fires them fast. He doesn't do long improvement plans, doesn't do second chances. You either perform or you're out. This sounds harsh. It is harsh, but it's also honest, and it creates a high-performance culture. People know where they stand, they know what's expected, and the people who can't perform self-select out. Let me tell you about Sam's real estate philosophy in different sectors. Apartments. Sam loves apartments. Stable demand. People always need housing. If you're in good locations, near jobs, near transit, you've got pricing power. Rent growth tracks inflation. It's a great business. Office buildings. Sam built his fortune on office, but he's very location specific. Class A buildings in major cities, those work, but suburban office, Class B and C, he's skeptical. Work from home is killing that segment. Sam sold at the right time. Retail. Sam's mostly avoided retail, even before e-commerce. He always thought retail had too much competition, too much supply, thin margins, hard to make money. He was right. Industrial. Sam's been buying industrial lately. Warehouses, distribution centers, e-commerce needs space. Last mile delivery. This is a secular growth trend. Classic Sam, find where demand is going and buy ahead of it. This sector rotation shows you how Sam thinks. He's not married to any one asset class. He goes where the opportunity is, where supply-demand is favorable, where he can buy cheap. And when the opportunity's gone, he sells and moves to the next thing. Now let me talk about what Sam got right about timing, because this is his real genius. Most investors can analyze a deal, they can underwrite cash flows, they can calculate returns. That's not hard. What's hard is timing. Knowing when to buy, when to sell, when to wait. Sam's been exceptional at this. Not perfect, nobody is, but exceptional. He sold equity office in 2007 at the peak. He bought aggressively in 2009-2010 at the bottom. He's repeated this pattern multiple times across his career. How does he do it? He watches leverage. When everyone's borrowing heavily, when debt's easy to get, when covenant-light loans are everywhere, that's a sign the top is near. Because easy credit inflates prices, creates bubbles. When credit's tight, when banks won't lend, when everyone's scared, that's when you buy, because prices have fallen below intrinsic value. It's not rocket science, but it requires discipline. It requires being willing to sell when everyone thinks you're crazy for selling, and being willing to buy when everyone thinks you're crazy for buying. Sam's got that discipline, that's why he's made billions. Let me talk about Sam's lifestyle, because it's interesting. Sam's worth $5 billion, but he doesn't live like a typical billionaire. He doesn't own a yacht, doesn't own a private island, doesn't collect art, doesn't live in a mansion. He's got a nice house in Chicago, nice but not crazy. He rides a Harley-Davidson to work, wears jeans and leather jackets, smokes cigars, hangs out with his friends, goes to concerts. He lives the life he wants to live, not the life people expect a billionaire to live, and he doesn't care what people think. This is freedom, real freedom, not having to perform, not having to signal status, just living authentically. And Sam will tell you money's great, but it's not the point. The point is freedom, the ability to do what you want, say what you think, not answer to anyone. That's what he's built, not just wealth, but freedom. Let me talk about Sam's advice for young people, because he's given a lot of talks, a lot of interviews, and his advice is consistent. First, take risks when you're young. You have nothing to lose, no kids, no mortgage, no obligations. This is when you should be swinging for the fences, starting companies, making bold bets. You can always get a safe job later. Second, be curious, read everything, learn about different industries, different business models. The more you know, the more opportunities you'll spot. Third, be liquid, don't trap yourself, don't take jobs you hate just for money, don't buy houses you can't afford, don't get locked into lifestyles that require constant cash flow, keep optionality. Fourth, think for yourself, don't follow the crowd, don't do what everyone else is doing. The crowd is usually wrong, find your own path. Fifth, be honest with yourself, with others, don't lie, don't spin, don't bullshit. It catches up to you eventually, just tell the truth. These aren't complicated, but they're powerful, and if you follow them, you'll be ahead of 90% of people. Let me talk about Sam's influence on the real estate industry. Before Sam, real estate was mostly a local business. Small operators, family businesses, no scale, no professionalism, no institutional capital. Sam changed that. He pioneered the REIT model for office and apartments. He brought Wall Street capital into real estate. He professionalized property management. He created scale. Now real estate's a global asset class, trillions of dollars invested, institutional investors, public markets, professional management. Sam didn't do this alone, there were others, but he was a pioneer, a leader. And his contrarian approach, buying distressed assets, selling at peaks, that's now standard. Every real estate investor talks about buying in downturns. That wasn't common before Sam. He changed how people think about real estate, from a passive asset to an active business, from local to national, from private to public. That's his legacy beyond just his personal wealth. Now, let me talk about what we can learn from Sam Zell for our own lives and businesses. Here are the key lessons. 1. Be contrarian. The crowd is usually wrong. When everyone's buying, you should be selling. When everyone's selling, you should be buying. This is uncomfortable. It feels wrong, but it works. 2. Watch the cycle. Every market has cycles. Boom, bust, recovery, repeat. Don't extrapolate the present forever. When things are great, prepare for bad times. When things are terrible, prepare for recovery. 3. Keep liquidity. Always have dry powder. Cash, credit lines, something. The best opportunities come when nobody else has capital. If you're fully invested, you can't take advantage. 4. Use leverage carefully. Debt amplifies returns, but it also amplifies risk. Never use so much debt that a downturn forces you to sell. Match your debt terms to your hold period. Keep cushion. 5. Buy below replacement cost. This is your margin of safety. If you're paying less than what it would cost to build from scratch, you're probably getting a deal, even if the market's soft. 6. Focus on cash flow, not just appreciation. Cash flow is real, it's predictable, it pays your debt, it gives you staying power. Don't rely on things going up. 7. Operate, don't just own, don't be passive. Improve what you buy, increase occupancy, raise rents, cut costs, create value. Don't just hope for appreciation. 8. Be honest with investors, with partners, with yourself. Don't spin, don't hide problems, just tell the truth. It builds trust, and trust is everything in business. 9. Take risks early. When you're young, you can afford to fail. Take big swings, try things. You'll learn more from failures than from safe bets. 10. Stay liquid in life. Don't trap yourself in golden handcuffs. Don't buy too much house. Don't commit to lifestyles you can't sustain. Keep optionality. Keep freedom. These lessons aren't specific to real estate. They apply to any business, any investment, any career. They're timeless principles. Sam didn't invent them, but he's executed them better than almost anyone for 50 years through multiple cycles. That's why he's worth $5 billion. Let me talk about Sam's role in the 2008 financial crisis, because it's instructive. Sam didn't cause the crisis, but he profited from it massively because he sold at the top, had cash ready, and bought at the bottom. Some people criticize this. They say he was lucky, that he couldn't have predicted the crisis, and they're partly right. Sam didn't predict Lehman would collapse, didn't predict the credit freeze, didn't predict how bad it would get. But he didn't need to predict specifics. He just needed to recognize that prices were too high, that leverage was too extreme, that risk was being underpriced, and that when that happens, bad things usually follow. So he sold, not because he knew what would happen, but because the risk-reward was unattractive. Better to sell early and miss some upside than to sell late and take huge losses. This is risk management. You don't need to predict the future. You just need to recognize when the odds are against you. And then when the crisis hit, Sam was ready. He had cash, he had experience buying distressed assets, and he had the psychological fortitude to act when everyone else was paralyzed by fear. That's why he made billions, not from predicting the crisis, but from being prepared for it and having the courage to act when it came. This is the essence of contrarian investing. Position yourself to benefit from volatility, from cycles, from fear and greed. Most people can't do this. It's too uncomfortable, but if you can, the rewards are enormous. Let me talk about Sam's health and mortality, because at this point, Sam's in his 80s, still active, still investing, still riding his motorcycle, but he's thinking about legacy. He's given away hundreds of millions to charity, primarily to education. University of Michigan, his alma mater, business schools, entrepreneurship programs. He wants to help the next generation of entrepreneurs. But he's not doing it for tax reasons or for PR. He's doing it because he believes in entrepreneurship, believes in risk-taking, believes that's how progress happens. And he's written his autobiography, Am I Being Too Subtle? It's a great book, honest, entertaining, full of war stories. He's laying out his life, his thinking, his mistakes, for anyone who wants to learn. This is generosity, sharing knowledge, sharing lessons. Helping others can avoid his mistakes and replicate his successes. Not every billionaire does this. Some hoard knowledge, hoard advantages. Sam's sharing, that's admirable. Now let me bring this all together with the bigger picture of what Sam Zell represents. Sam represents pure capitalism, creative destruction, buying low, selling high, profit-seeking, risk-taking, no apologies. Some people don't like this. They think it's vulture behavior, profiting from others' distress. But Sam would say, I'm providing liquidity when nobody else will. I'm taking risk when everyone else is scared. I'm creating value by improving operations, and I'm getting compensated for that risk. And he's right, markets need people like Sam, people who will buy when everyone's selling, who will take the other side of panic, who will provide capital when it's scarce. Without people like Sam, markets don't work, prices don't clear, assets sit vacant, value gets destroyed. Sam's performing a function, and he's doing it better than almost anyone for 50 years. That's why he's rich, not because he got lucky, not because he scammed anyone, but because he's exceptionally good at providing liquidity and creating value in distressed situations. That's capitalism at its finest, and Sam's a master of it. So what's the ultimate lesson from Sam Zell? It's this: success comes from being right when everyone else is wrong, from acting when everyone else is paralyzed, from buying cheap and selling expensive, from managing risk ruthlessly, from staying liquid, from thinking long-term, from being honest, from not caring what people think. These are simple principles, but they're incredibly hard to execute because they require you to be uncomfortable, to go against the crowd, to be contrarian. Most people can't do it. Their psychology won't let them. They need social approval. They need consensus. they need to feel safe. Sam doesn't need any of that. He's comfortable being alone, being contrarian, being the guy buying when everyone else is selling. And that's why he's made $5 billion. That's why he's one of the greatest real estate investors in history. That's why he's the grave dancer. Alright, so that's the story of Sam Zell. That's how a college kid who bought his first apartment building at 21 turned into a $5 billion contrarian investor. That's how he survived and thrived through multiple market cycles by selling at peaks and buying at bottoms. That's how he earned the title Grave Dancer, by making billions in other people's disasters. The framework is simple but brutal to execute. Be contrarian, watch cycles, keep liquidity, use leverage carefully, buy below replacement cost, focus on cash flow, operate actively, be honest, and have the psychological strength to act when everyone else is frozen. If this kind of deep dive research into how real fortunes were actually built resonates with you, if you want to understand the actual playbooks, the real decisions, the specific strategies that created billions, hit that subscribe button. New episode every single day. Tomorrow's another founder, another crisis, another contrarian bet that changed everything. I'm Alex Morgan. Thanks for listening to Behind the Billion.